Welcome to Investor TV. I'm Michael Switow. Today we take a deep dive into gold in this, our first edition of Navigating Capital Markets. We have an absolutely fantastic panel for you today. Some of the best minds in the industry. They have more than 100 years of experience between them. We kick it off with three leaders of mining exploration companies. Taj Singh is the CEO of First Nordic Metals. Brandon Bonifacio is the head of Nev Gold. And Frank Callahan is the driving force behind Golden Caribou Resources. Joining us as well is someone who truly has his finger on the pulse of the commodity markets. John Fennick is an analyst, an investor, and the president of Fennick Consulting. Gentlemen, welcome to the show.
Nice to be here. Thank you.
Thanks, Michael.
Over the next hour, there are two main themes that we're going to explore. First, is gold a good investment, even at its current levels? And second, if so, what is the best way to profit from it? You know, over the past couple of years, gold has had one heck of a run, but it has given up a bit of ground over the past month. The precious metal is up about 45% over the past 18 months or so. The enthusiasm over gold can perhaps best be seen at the consumer level. Costco is estimated to be selling $200 million in gold bars every month. And in Korea, there are actually vending machines in convenience stores where you can buy gold. So I'm wondering, are these signs perhaps that the gold run is overdone? Are we in the midst of a bubble that's ready to pop? John, what do you think?
No, there's no bubble here. I think it's two camps. You're either in the camp that, NVIDIA is going through the roof and tech and AI are going to continue to lead and Bitcoin at 70,000 is cheap, or you're in the camp that, physical assets like gold, silver, real estate matter. And there's a lot of billionaires on our side of that equation as well. So I don't know how this is going to end, but we're clearly in Camp B, and we don't chase anything. So, we think that the markets here have had a huge run since March of 2009. If you look at, a 15 plus year run, that run is going to end badly here in the next, 12 months or so. And people are looking at that intelligently. It's not just central banks, it's retail saying, I want some gold in my portfolio.
There are a number of possible theories as to why gold prices have been trending higher, from interest rates and US deficits to inflation and geopolitical uncertainty. So let's take a look at the demand side of the equation. I'm going to go around the room for this, starting with you, Frank. What do you think is the number one factor currently driving demand?
Definitely geopolitical. The instability just worldwide is probably the driving force of it. And then that's followed by the banks are large consumers of gold at present. They're definitely buying all the banks around are definitely buying they're increasing their portfolio.
All right, so we have geopolitical uncertainty. We have central banks that are buying. Taj, what would you say is the biggest source of demand?
Yeah, I think for me, it's central bank buying. It's growing year over year. It's driven heavily by Asian buying overall. And again, I think this is mostly driven by fears of further money printing to finance overall global debt. Money printing after COVID has been off the charts, and you can see the levels of overspending here in Canada, for example, because I'm here, has now led to mass and there's an inevitable printing of money that needs to happen. So gold holds value. So, for example, a high-end suit today costs about equal to 1 ounce of gold. It's no different than it did 100 years ago when you look at purchasing power. So I think right now what's very interesting, just to sum it up, is central bank buying is driving this new level, even though we're in such a heavy inflationary environment. So I think this is a little bit tying into John's original question. This is early innings.
I love that analogy for buying a suit, that it's still the same amount in gold. And you talk about central banks, and we're definitely seeing a lot of central bank buying here in Asia, where I am. China is a big buyer, but not just China. There's also central banks in Singapore, in Europe, that are also stocking up on gold. Brandon, what about you? What are you seeing in terms of demand factors?
I think further building on the first two, which I completely agree with, I think also a lack of trust in the global financial system and obviously the debt super cycle that we've seen. And as Todd just mentioned, a lot of the money printing and frankly, people not believing in the system and the people that are running it. So I think that will continue. And I think it's one of the asset classes that is and has that safe haven characteristics that I think people look for. And I do think we are in the first inning at most at this stage. I think there's a lot more room to run. And you even look at the inflation adjusted gold price. I don't think we're even at all-time highs when you inflation inflationary adjusted over the past couple of decades. So there's a lot more room for it to run over the foreseeable future here.
All right, a lot more room to run. I just want to remind our viewers that today's discussion is also an opportunity for you to pose questions to the panelists. So to do so, just find the Q&A button on your screen. If you're on a PC, it's at the bottom center of the screen. If you're on a tablet, it should be located near the top right. All right, let's talk supply. Basic economics says that when demand rises and prices go up, new suppliers will invariably enter the market, which in turn could bring the prices back down. Given that gold prices are trading near record highs, I'm wondering, are we seeing new miners come online? John, what have you noticed in this regard?
Well, it doesn't matter what commodity an exploration company, a development company, a producing company is involved with. It's simply not possible to flip a switch and turn on production. And this is something that the average client has no clue about. Honestly, it takes years and years and years. It depends on the commodity. I mean, uranium, it could take 20 plus years, right? It's better for gold, silver, and copper, but not much better. And Goldman Sachs put out a piece in Barron's last January, so it's 18 months ago, but I just remembered it was the cover story about copper and how it would take 5 to 7 years to, just like if we turned on the mines today, it would still take 5 to 7 years because you have to fund that. You've got to get employees, you've got to get permits, you've got to get all this stuff going, right? So if we said we're in a deficit, we realize this, it's not easy to fix. And it's less easy to fix in minor commodities, like, down the critical mineral list, like 8th, 9th, 10th on the list. Things like tellurium, tungsten. I mean, we're in bad shape in the U.S. in terms of looking at how China has just dominated the space. And I know from just being in D.C. about 4 weeks ago with some of the people here, the vibe is the U.S. government is starting to recognize this, which is extremely positive, but I think they're very late to the game.
All right, so we've talked demand, we've talked supply. Let's get at the intersection of these two and talk price. Gold is currently trading around 2,380 US dollars an ounce. I'd like to hear from each of you. What is your projection for where gold will be trading a year from now? Brandon, let's start with you.
I think we could easily see $5,000 per ounce. And I think it's a function of kind of us being in early innings, but also that there is that inflationary adjustment that has not occurred yet. And I think the demand will continue from a lot of those aforementioned groups and players.
Okay, fantastic. Thank you. Didn't mean to cut you off, Taj. What about you?
No, I was just waiting there. But listen, I think honestly, kind of by year end, Q1, Q2 next year, 2,700 to 3,000 is very reachable. I mean, you're seeing even big U.S. banks who have essentially been bears on gold for a decade here. They're even calling it, so it's showing the sentiment change in sentiment is pretty telling. But I think very reasonably 2,700 to 3,000. I gave a range, but I'm covering myself.
Okay, Frank, what do you think?
I agree with Taj. We've seen it double from 2008 to 2012. We've seen it double again from 2012 to where we are today. And there's I think as interest rates start to come down, and I'm not really a big believer that they're going to come down an awful lot over the next couple of years. I think that we may be seeing higher interest rates for the future. But at the same time, I think that Taj is right on the money on it. I can see $3,000 possibly by the end of the year. But that would be a real stretch. I think that probably sometime in the next 18 months, I can see it go to that level if interest rates will start to come down a little bit faster.
Okay, you're up next, John.
Yeah, so as we record this, it's testing 2,300. So I think, a range of, like we said 6 months ago, $2,500 target for this year. So I'd say 2,500 to 2,700 in keeping with Taj's range. I think that's a safe range. I'm always very conservative. Even though silver was my largest position for all of last year, we were saying it couldn't break 26. We're looking long term at this sector. And for your listeners, if any of us are right with our 4 predictions, all 3 of these stocks that are represented here today are going to rip, because there's tremendous leverage to the price of gold in little gold stocks. And these are all companies that are very well run, in my opinion. So I think that's where we're spending most of our time, Michael, is in the equity side, looking at cheap gold stocks and talking to people like Brandon and Frank and Taj on a regular basis.
Okay, that's awesome. We have a question in the audience. We're not going to do it right now, but I just want to share that we are going to get there, which is what you recommend in terms of physical gold versus a gold stock versus an ETF. That's definitely a theme we're going to get to in just a little bit. And I think it is interesting that you're already raising that there is definitely good opportunity in those mining stocks. Sticking for a second with the price of gold, I spoke with Eric Strand. He's a European fund manager not too long ago. And he said, and it kind of echoes what Brandon said, that he thought that gold would still be cheap at 3,000 or even 4,000 US dollars an ounce. John, do you think that's fair to say?
I mean, we're a little bit different in that regard, in that I think the gold price has run already quite nicely, as we've talked about. I think the gold stocks need to play catch up to the gold price move, and so that's where I'm spending my time.
All right, I want to share a couple slides here. So right here we are showing the price of gold, and you can see where it's been running up. But I think that younger listeners in particular need to realize that commodity prices don't always go up. And I think that you could even talk about perhaps having a lost decade. So if you look at the price of gold and you go back to about 2011, 2012, well, you can see where it was on the graph, and it took nearly a decade for it to come back after it fell. See a similar trend with silver, which actually hasn't caught up. And you also see with copper that volatility. So I just want to ask you, is there any concerns that any of you have that this sort of activity could repeat again? I mean, because you've been through a few cycles. Frank, what do you think?
It can definitely go down. There's no doubt about it. But the trend is your friend, and I think that for the foreseeable future, I think we're going to see a steady increase in the price of gold, and it should level off once it reaches a certain level. And I think that we might see that somewhere north of $3,000 an ounce, and hang in there for probably a few years. There's nothing wrong with the price of gold as it is right now for anybody that's in the mining business. And for the exploration business, it's definitely incentive to keep working. But you can see corrections; it's normal. But I think for the foreseeable future, it's an up. The trend is your friend here.
Trend is your friend. Taj, what about you?
Yeah, listen, I think it's like I said, we're in the early innings of all the boxes have been ticked for a serious bull run. And when you have, like I said, big U.S. banks are basically bears on gold for a decade, all of a sudden calling for huge increases in gold price. That to me is saying it's pretty evident that it's going to move. And like I said, all the items are kind of lined up there for it to move. And listen, it's actually behaving pretty nicely. You notice it goes up, goes to 24, down a bit, settles, then we get another leg up. And again, this is all really in a heavy inflationary environment. Imagine, as Frank talked about, when the interest rates start coming. I mean, Canada already did a major one. Europe has started doing it. They're starting to happen. But when those really take full effect, it seems like everything's set for it to move. So completely agree with you that it's important for investors to know that these things move in cycles. I think, but it's about as textbook as you can have it that gold's ready to move here.
All right. Well, you all mentioned a little bit ago about how long it can take for new supply to come online. I mean, it can take at least 10 to 20 years on average before a new mining project is ready to, that's being, worked on, before that material can be refined. And I'm just curious, Brandon, can you tell someone who's a layman, why does it take so long?
Just the development timelines for these projects is not an overnight process. There's obviously the exploration phase, the development stage, the engineering phase, the permitting phase, and most of the time that can take 7 to 10 years minimum, even if things go very well from a financing or capital raising standpoint. So these are not light switches. They never will be. And I think that's what creates an opportunity with some of the advanced project and companies that are frankly presenting today. I think the ones that do have resources in the ground will be the ones that get rewarded in the early stages of a commodity secular super cycle.
So it all starts with management. You have to call people like Frank, Brandon, and Taj. And if you don't have the time to do that, I get it. You need to work with someone like myself that has the time, that is involved in the sector on a day-to-day basis. I speak to 15 to 20 CEOs a week, and not everyone has the time to do that. But it gives me a good feeling Like if I'm talking to a really kind of monotone person and they have two projects, one in Mexico, one in Chile, and they're always in Mexico, but all of a sudden they're starting to go to Chile a lot. That gets me interested as to why someone who lives in the US is traveling all the way to Chile all the time, who's in his 60s, right? Like, so I'm going to call him and say, why are you doing this? And just see if I can get some type of feel for the direction of what's happening, because they're probably more excited about that project all of a sudden, right? And then you look at the time frame to production. I mean, that's another thing. Some of these projects will take many, many years, as Brandon pointed out. But I don't think that people are understanding of the fact that the producers need to fill their reserves, right? And so they're going to be coming after smaller companies, whether it's micro caps, small caps, mid caps, and partnering in some fashion with these companies, or flat out taking them out in the next 1 to 2 years. If we're all right with our goal predictions, these companies are already sniffing around. If you've looked at M&A activity, Michael, over the last 12 months, it's been picking up dramatically, and I think that trend is going to continue.
So Frank, next question for you. As the head of an exploration company, how do you choose what's a good site or a good project?
Location, location, location. It's you want to be in a mining friendly area for openers. It's all about being in the right rocks and in a friendly jurisdiction. So Canada is a pretty friendly place to be working. It's a safe jurisdiction to be working. Where we're working in central British Columbia, it's a mining friendly area, and that's being in the right area. That's the whole key. And you got to be in the right rocks and in the right area and a friendly place. That's number one for us.
Well, Frank, you just answered a question from one of our viewers, Scott Young, who was asking what makes British Columbia a good mining investment. Taj, what about you when you're looking at where to, put your resources? Is there a particular land size or any sort of geological formation that you really look at to say, yeah, this is where I'm going to focus?
Yeah, I think I'll echo Frank's comment. His jurisdiction is huge. We're seeing that in a lot of countries around the world. Market caps have dropped drastically all of a sudden because of something that's happened at the country, socially, politically, something like that. So jurisdiction is huge, and obviously it goes without saying is the geological setting has to be there. That's ultimately what's there. And those are kind of two key things. And then as you progress the project, I think what's an important thing to note is, what's an eventual size of project you kind of need to move things forward. And like in gold, back in the days, 1,000,000 ounces, that's it. There's the mine, you're done. If you had the right grade and things like that, and there was high enough margin, sure, it probably could be. But it looks like a lot of people, what I'm seeing from our own due diligence on things, as well as I know from speaking with others, is 1.5 million is kind of what you need now. They're kind of looking for the first 500,000 to pay for capex, and then the rest of it being kind of profit margin. I think the new kind of trend, specifically I'm speaking of gold, is kind of you want that kind of size of 1.5 million. You want a good land package. You talked about that. You need to be sure that if you expand the deposit, you've got room. You need room for infrastructure. So it's kind of all these components. But I think picking the right country, for sure, commodity obviously, commodity country, and then obviously in the right geological setting is vital.
Brandon, I noticed you were nodding your head to a lot of what Taj said there. Anything you want to add to that?
I think spot on from both Frank and Taj. And I think projects that actually have the ability to become a mine one day. And there's a myriad of factors that go into that. But as Frank and Taj just touched on, those were 3 to 5 of them right out of the gate. So.
All right, John, I want to turn back to you because you do invest in mining companies. So I'm kind of curious what criteria or screens you use to determine which ones to invest in.
Well, we already talked about management. That's number one. Number two is the project itself. I mean, you have to have a good project or else it's not worth looking at, right? And there's a number of factors that go into determining whether a project is good, great, whatever. Thirdly, and a very close third, would be jurisdiction for me. As Frank pointed out, and pretty much everyone here has pointed out, when you're looking at the 3 companies presenting today, they're all in good jurisdictions, right? And that's really important because I don't like getting surprised. Neither does any other investor If you look at the largest royalty company in the world, Franco-Nevada, are you going to tell me that they weren't surprised by Panama? I mean, this is a difficult sector, and you have to put your money into areas that are going to do better over long periods of time, or look, as Gretzky used to say, where the skates where the puck is going. In the U.S., we have an election coming up. Do you think Trump is more supportive of mining than Biden? Absolutely. So, like, in a world like that, if Trump wins, we're already positioning more assets in the U.S. in case that happens, right? Because we already know what Biden is doing, right? We already see that hand for the last 3.5 years. So now we're gonna try to put more assets. We're heavily overweight U.S. Canada right now for a reason, because the world is getting weird, and so you have to kind of put your Taj has got a project in Sweden. I consider that a good jurisdiction. There's definitely outliers, but you have to do your due diligence more and more these days.
Frank, do you agree with John's criteria? Anything you would add to the list?
No, having put a couple in the production in British Columbia, and we're in that area right now, looking for another one. And I think that the friendlier the place to work, the easier it is to get them permitted. The easier it is to find shareholders that will want to join on. And like John mentioned, like the Panama scenario is just devastating for that company in particular. But you got to be in a friendly place where you know that when you own the land, you're able to work on the land, that it's yours, and you don't have to worry about losing title to it.
All right, I just want to send out a reminder now to people who are watching that you can pose questions as well. We will be getting to more of them as we go forward. So just look for that Q&A button on your screen and type in your question, and we'll do our best to get to it. I want to segue now to the second major theme today, which is what is the best way to invest in gold? Now, there are three major avenues: buying physical gold, gold ETFs, or investing in the shares of mining and mining exploration companies. We're going to take a look at each of these in turn, starting with physical gold. I mean, this might seem to be the most direct mode of investment, but if I'm buying substantial quantities, I should say, not something at a jewelry store or at Costco, then I got to consider storage. Brandon, to what extent can storage, transfer, and insurance costs cut into my profits?
Yeah, I think it's a part of the holding of the physical commodity or physical gold aspect. I think holding physical is an important way to build a portfolio, but I think the real leverage or torque will come from the equities and some of the names that we have on the panel here today. So I think having a blended portfolio, like any portfolio that's built in any sector, it's important to have different asset classes and weightings within that. And I think holding physical is one aspect, but I think holding the equities is where most investors will get rewarded in this next cycle.
Okay, well, we'll get to those equities in just a moment, but sticking with the physical gold, I'm just curious about why someone would do it. I mean, Frank, is the main advantage just the fact that I can hold it in my hands and I can say, hey, central banks are buying physical gold, I should too?
It's a great store of value. So having physical gold is a wonderful thing to have. It's it's there. You can sell it anytime you want. You can go buy a suit with it apparently if you want to as well. But no, it's owning gold is a good thing to do. I encourage people to own some of it. I own some of it. I think it's a wonderful thing to have. The bet is on buying junior companies and stuff. I think that there's a better hedge on making money with gold, but I think that owning physical gold is a very good thing to do.
John, do you agree that someone should have physical gold in their portfolio?
Absolutely, but every single investor is different, and they have different risk tolerance than me. I'm an equity manager, so I'm looking at taking risk, but taking risk carefully, by doing my homework, and that takes a lot of hours to do that. A lot of people that have just bought gold here since, let's say, call it 2016, when some of these same bankers that are now calling for much higher prices were calling for, I remember Wells Fargo and some of these guys calling for $900, $1,000 an ounce in Q1 of 2016. Serious egg on face. It's just it should be a part of everyone's portfolio, but to differing degrees.
Taj, what are your thoughts on physical gold?
Listen, it's I echo the thoughts of the guys here today. It's harder to turn to cash, I'll tell you that. But if you truly want to, develop a kind of well-diversified, say 10% of your wealth is in gold, it's nice to kind of set up a basket of, of all the options you mentioned, physical, some ETFs, and then there's the gold stocks. And even within gold stocks, who I'm sure we're going to get to it, is the producers, developers, and explorers. And there's different levels of risk and different levels of reward even in those. I think physical gold is the least risk, but probably the least reward. That's how I kind of look at it. But exactly as John pointed out, if you're like, this is about to be a bull market, you probably want to be much more heavy on the gold stocks, in my opinion. I'm sure we'll get to it. But if you kind of want to over time hold gold, regardless of cycles, you probably just hold physical gold, and you're going to do very well as well.
So Taj, we have a question from the audience which says, and you're talking about bull market, and the question is, how long, how many years do you think this gold rally is going to last? What's your take on that?
Listen, I think 7 to 10 makes sense, and I think John will have even an even more educated answer. He's been doing this, for decades. But yeah, I think 7 to 10 makes sense in terms of a cycle, and I really truly believe we're in year 0/1. So yeah, that's my thought.
John?
I've got a little bit of an interesting take on this. And when you look at like past corrections, right? If you look at 00 to 03, it was devastating. It felt like it was forever. It was multi-year, right? 08, 09, although it was terrible, was less than 1 year, more compressed, right? If you look at the pandemic, for example, 2020, very quick, 2 months, a V-shaped recovery. So I personally feel rallies and fades are getting more compressed because of algorithmic buying and selling. And so I would believe me, if Taj is right, we're all going to make a lot of money on this webinar. But let's just say that I'm a little more conservative, that I think that things will get ahead of themselves, much like they have with the broad market, where you're going to get some euphoric buying. Because again, it's important to stress, since we haven't brought this up, that many people in my chair are talking about a black swan event to get gold to 2,500, right? We haven't had that. What happens if we do have that, God forbid? And what happens to the gold price then? It's already in rally mode. So what we've been telling our investors is, this has all happened without that black swan event. And I think it's possible that we see that within 12 months, whether it's market related or not.
Interesting. Very interesting. I want to turn now, and the next on my list after physical gold is ETFs. But before we do that, I want to take a step back and look at gold in comparison to equities and in comparison to other commodities. And so if we look at this slide here, we can see that gold, this year is outperforming major US stocks. But if we take a slightly longer term perspective, it's not. And that's mainly due to, I would say, to tech stocks. Meanwhile, if we look compared to other commodities, you can see that, over this 12-month period, that silver and copper have actually outperformed gold. So Taj, I believe you're on the board of a silver mining company, as well as, being working in gold. Would I be better off investing in silver and copper, perhaps?
I can speak to silver for sure. I was founding president and CEO of Discovery Silver, which has the world's largest silver deposit sitting in Mexico, in Chihuahua, Mexico. And we saw when we started getting to 30, kind of 2019, 2020, into 21, 22, silver moving in through the 20s, huge increase in market cap, and we were able to bring in and really bring in a bunch of investors and grow that company in a very large way. But listen, silver is a lot more volatile than gold, right? If you can time it right, you can really probably make some outsized returns, even in comparison to gold. But it's really volatile. The market's way smaller. So if you're really in a precious metal bull cycle, that silver cycle I talked about is going to be much shorter than the gold cycle. But I think, listen, the gold silver ratio is probably 80 to 1 now. I think in a real silver cycle, it can get to 50 to 1 or less. I mean, I've heard numbers of 15 to 1, which is a little crazy, but a lot of the silver bulls will say that can happen. But Definitely, if you time it right on silver, your entries and exits, which is always interesting, you can definitely make outsized returns on silver for sure, I think. Copper is more of a demand supply thing, and I think it's, if you put it in and you have a long-term view on copper that this is gonna, demand's gonna increase, and there's not enough supply for it, you can stay, strong and long with copper. But silver is a pretty unique one. I'm sure the other panelists have some thoughts on that, but you can really clean up on silver if you pick it right.
Frank, you've been in commodities and mining for some time. You've seen different cycles. What do you think about silver as opposed to gold?
Well, silver is definitely on a bit of a tear. There's no doubt about it. And like Raj said, that it's on the move. I personally believe more in the gold market than I do in the silver market. And I've been sort of focused on that part of the industry as well. They all sort of go in tune together. And, we've got an economy that's sort of trying to come out of the doldrums. That's why you've got a copper market that's really improving as well. So all three of them, you're in a horse race, and all three of them are performing. Which one's going to come out of it on top? That's yet to be seen. But all three of them are a great commodity to be involved in, but I think that you're going to see more of a gold market than you will of a silver market.
All right, well, Frank, I'm originally from Kentucky, so I love a horse race. So I'm going to keep my eye on that for sure. I want to turn to the ETFs now, and two of the biggest on the market are the iShares Gold Trust and SPDR Gold. And if you look here, their returns are more or less comparable to the price of gold. So as an investor, I'm just wondering why I should consider a gold ETF as opposed to physical. John, what do you think? What can you tell us on that?
Well, I'm probably gonna get myself into some hot water here because most of our listeners are probably, physical bugs. And I will say that coming from the ETF world and working in it for many, many years, having placeholders in ETFs is fine. I mean, in most markets, I'll make it. I'll make a point here. In October of 2016, IAU, which is an iShares product, right? Huge in terms of assets under management, could not deliver physical gold. You can go back and Google search this. It actually happened. It was on a Friday on the front cover of the C section of the journal, and it only happened for one day. And it hasn't really happened since. But I think this is the kind of market where it could happen. And that is kind of a mini black swan event to me, right? Where people say, oh, wow, all this stuff that people have been saying all these years is true. These ETFs can't deliver the metal. So there is, an argument for sure that you want to own physical over ETFs. I'm just saying in a normalized kind of market that ETFs could be an option for certain people.
Well, you just made me think of the nickel markets, right? And there were these controversies where it was supposed to be bags of nickel, but it was actually stones. Unfortunately, we haven't seen that with gold. I hope we never do. But that idea that an ETF couldn't deliver the physical gold when it has to, definitely a black swan event. Let's go ahead and take a look now at mining companies, which I think is really maybe the heart of this discussion. And I'd like to divide it into a couple categories. We have the big three gold miners, Agnico Eagle, Newmont, and Barrick Gold. And if we look at the slide here, just a couple months ago, they were lagging behind the gold rally. If we look at the latest prices, there have been some gains, but Newmont and Barrick are still a bit underperforming vis-a-vis gold. So those are the big ones. The stocks of these companies are actually doing not as well as the stocks of the companies on this panel. So Golden Caribou, First Nordic, and Neb Gold are all outperforming this year. You can see 138% return, 115% return. The case is a bit different if you zoom out to 2 or 3 years. In that case, they still have some ground to make up. But this is also not the case with all the junior mining companies. You can see quite a few are definitely underperforming, and they're actually still in a bear market. So I want to ask you, John, why are some of these mining stocks underperforming?
Well, this is a very long answer. Can we go back to the first slide you just showed there in the series of 3 that showed Agnico, Newmont, Barrick? I just want to set this up for listeners. So, the largest ETF in the world is GDX, ran by Van Eck and Joe Foster's team. Interestingly, Agnico, Newmont, and Barrick represent 30% of that ETF. So, this is a very good representation of what's happening in the producer world. Agnico has been on a tear. Their numbers have been great. Newmont, with the Newcrest merger has been that's been, in my view, what's been holding it back. And Barrick has just underperformed. But look at the gold price return of 15% here year to date versus Newmont and Barrick. It's ridiculous. I mean, investors want 2 to 3x returns if they're going to take risk in equities to the price of the underlying metal. It doesn't matter if it's gold, silver, copper, whatever, right? We call that leverage. So why is it underperforming this much? That's what's frustrating investors. I think my message to investors is be patient because there will be a catch-up move here. Gold has led. That's not atypical in rallies. What is atypical is that Newmont and Barrick are lagging, right? Like Agnico is doing what it should be doing, but the others have not done what they're supposed to be doing, and it's just a matter of time, in my opinion. And Michael, what was the second part of your question?
So why are the mining stocks underperforming? Has something changed since COVID or post-COVID that has affected them?
There's a number of factors, but I think post-COVID, you're seeing CapEx go up in a lot of projects, and that has deterred investment. I think the first one that I remember, a couple of years, maybe 3 years ago, was Argonaut kicking things off with a huge CapEx miss. And that really surprised investors. That chart looked beautiful before that announcement. I remember it was in December, and the thing just got crushed. And then you saw a lot of other companies say, oh yeah, as a result of COVID and all these supply disruptions, our CapEx has doubled or tripled, like in some cases. It's like, wow, okay, so the price of the metal has to catch up, right, to make the economics of that project work. And that is just starting to happen in gold. But it's not really there yet in silver and copper. I mean, I think that chart that you showed about year-to-date performance about the three commodities was slightly misleading. Not that you meant it that way, but silver and copper just recently caught up to gold, right? Gold has been doing doing its job very steady. Copper and silver are explosive, and people forget that copper last year was flat the entire year, the commodity, right? Even though Goldman and a bunch of smart people were saying we see much higher prices over the next 24 to 48 months, it wasn't happening. But now copper broke out this year, silver broke out, silver above 30, which I know it dipped here just as we're recording, it's below 30. But I mean, the fact that it got above 30 on a Friday on heavy volume, very bullish action in my opinion. I mean, 30 is a major line in the sand. And gold bugs are looking at how silver acts, right? Because we want confirmation from silver that this rally is real, and getting above 30 indicates that we are in a bull rally.
Very interesting. Brandon, do you expect that mining stocks are going to catch up anytime soon?
I do. And having worked actually at Newmont, formerly Goldcorp previously, I think the last 12 to 18 months, they've been hindered by lack of operational excellence. I think the margins have been shrunk because of inflationary pressures to costs. And I think now they're starting to tame that I do foresee the next 12 to 18 months to be a lot stronger if commodity prices maintain at the high levels that they are. And if they can obviously get their all-in sustaining costs down and generate the proper margins that they should at the current commodity prices. So yes, I do think the next period is strong for obviously the producers, but also the developers and explorers as well.
So Frank, John was saying that he thinks that mining companies are a way to leverage, if you will, the gold rally because there's a lot more room to go. Would you agree with that?
I certainly do. I think going on with what Brandon was just suggesting is that once the earnings start coming out on the seniors, and I think the prices you'll start to see move, and the seniors really have to get going in order for the junior companies to actually start going as well. So you're going to, as earnings start getting published, and with these new higher prices that we're seeing in the commodity, that you're going to start seeing those companies, their share appreciation. And Barrick's just so undervalued. I think looking at that, trading at about $23 a share. So I can see them all going an awful lot higher, and then you're going to see a junior market. I think is going to follow right behind it, and you're going to see those move in multiples, and that's all. You're at the beginning of a bull, in my view. I think that this whole thing is just starting. We've had a downward cycle for a number of years, and I think it's the very beginning. The pendulum is just starting to go the other way.
Interesting. I keep hearing this beginning of the bull cycle, which, as an investor, as someone who's speaking with investors, I'd love to hear. Excuse me. If you haven't asked a question yet, please go ahead and do so. Just click on Q&A and type it in. We got a request from somebody for an elevator pitch from each of our three companies. And so I'm going to do that, but I'm going to limit you to 1 minute max. Okay. Taj, starting with you, give us your elevator pitch. Why should someone invest in your company?
First Nordic Metals, so we're focused on Sweden and Scandinavia. In Sweden, we own 100 kilometers of strike, over 100,000 hectares of the Gold Line belt, a very well-known belt that intersects with a very prolific basement belt as well. Right center of the belt, we have a 2.5 million ounce deposit that we're in joint venture with Agnico. And we think there's at least 6-7 targets on this belt that bear quite a bit of resemblance to that deposit. So our ultimate goal in Sweden is really to look at 5, 6, 8 million ounce kind of total potential. I think we have a huge land package, and we think we'll be able to create Europe's next gold camp in Sweden. And in Finland, we've got a very interesting project too that already has a maiden resource of around 300,000 ounces that we think we may be able to get towards 1 million with some work on it. So real focus on Europe. And I really think we're going to become Europe's next gold company to look at in terms of development.
Thank you for that. Brandon, why should someone invest in Nev Gold?
So Nev Gold's focused on the Western US. We have our 2 flagship resource stage projects, Nutmeg Mountain in Idaho, which has 1.5 million ounces, and then Limousine Butte in Nevada. I think the nice part about the story now, we're at the execution phase. So with more drilling this year, we're going to be able to take our 1.5 million ounce resource base to 3.5 to 4 million ounces. And as of recently, we've now actually picked up a copper project in Western Idaho, which is effectively surrounded by Barrick Gold and a recent discovery made by a company called Hercules Silver. So I think the gold assets create that intrinsic value for the company. And the lotto ticket is this copper asset that has garnered a lot of attention from the Canadian and global capital markets.
All right, Frank, you're up next.
Well, having put 2 mines into production in the neighborhood where we are right now, having had what the company purchased for by Osisko Royalties, that's confirmed 6 million ounces on the property, and they're putting that into production starting at about 160,000 ounces in the third quarter of this year. We're in just north of the 2 mines that we put into production already. It's the same exploration team that's working on this one, and we're finding gold in a rock formation in this area that hasn't been recognized as being gold bearing before. So it's really quite a significant discovery that we've made already. It's really early stages. I've really been only on board on this one for a couple of months, but it's very exciting, and we're in a very friendly mining jurisdiction. Blackwater's close by, 12 million ounces, 6 million ounces just down the road from where we are right now in the Barkerville, which is a Osisko development's now actually running. And it's mining friendly jurisdiction, and there's lots of gold. There's just lots of it.
Well, Frank, you mentioned jurisdiction, and we have a question from an attendee who says, John, as the expert, these companies are all in different jurisdictions. What is your take? What do you think about the jurisdictions that they are in?
So I just got done saying that I love the U.S. and I'm putting more money there. And I actually reached out to Brandon just a few months ago, really, to get a better idea of what was happening at Nev Gold, because I was interested in what I was seeing. Obviously, one of his projects is very close to Hercules. We all know that Hercules had an amazing run last year in a very difficult commodities market. So proximity plays are one thing, but you also have to have execution. And I think Brandon's team delivers that. And so we invested in that stock, which is NAUFF, the US ticker. Probably around 23, 24 cents. It's run up since then a little bit, but it's holding that 29 to 30 range really nicely, which is very bullish. Once you see a stock move up, you want to see it make what we call a higher low. And that's what Nev Gold is doing right now. And it's been doing it for weeks. So that's telling you that this move is real. First Nordic, we got introduced to that probably around 5-6 months ago. I just feel like Sweden is an interesting jurisdiction that I didn't have a lot of knowledge about before, but that's one thing that as a value manager, I push myself to do is to learn. 2 years ago, I didn't even know how to spell tellurium. And now First Tellurium is one of my biggest holdings, right? So you have to continually evolve in this sector. And Sweden to me is a safe jurisdiction, and so when you look at what Taj was saying earlier about having 1.5 million ounces is sort of a good starting block. Well, Dev Gold and First Nordic both have more than that, right? So like that's what larger companies are going to look for, I think, in terms of JVs and just straight takeouts is how much, how many ounces in the ground do you have, and that's important. So we like that project a lot. In terms of Golden Caribou, Frank and I just met for the first time in person. What about five weeks ago, Frank? And got a chance to meet my little awesome daughter in DC, and we had an awesome time hanging out, talking about your background. And to come out of retirement to start something always interests me. And you've had a lot of success in that same jurisdiction. The team you've built at Golden Caribou is very similar to the team that you had when you sold to Osisko 10 years ago. So that is always something we look for as well. Someone who's been in that jurisdiction before, knows what to do, and is sort of hitting the reset button on a new project.
We have another question. What is the exit strategy for these projects? So I'd like to go around the table again, starting with you.
Yeah, I think generally my kind of take on things, even when I take on projects, is you have to be pretty agnostic about the exit point, right? You can't say we're going to do X, Y, Z, and we'll get taken out, because of course you don't know if you'll get taken out, right? You might, but you have to be able to have the team in place, the asset, the backers, to be able to go ahead along on your own with it if you have to. And at some point, if something interesting comes your way, that's good for shareholders, sure. I mean, the most efficient way for sure, my take on it is the most efficient way still to sell it, to build up a project, get a resource, get it to the kind of study stage, whether it's a PEA or PFS, and then move it. Because you kind of have a bit of a lull during construction before you start production. But I think really, and I know I'm speaking for myself, is we're going to take these into production, right? That's our thought. But at the right time, of course, if there's someone who wants to take it, this is set up well, that someone thinks this is a very kind of attractive piece they can add, and a needle mover for them, which I think we really have, right? I've talked about the size already. I've talked about the jurisdiction. Everyone's looking at Scandinavia now. Big focus on Rupert Resources as potentially the next big takeout. All eyes are there, and really supportive government now, and especially in Sweden, also in Finland. But yeah, long answer here, but you have to. My thought is you have to be able to take it along, because if your value proposition, your thesis is that we're going to do this and we'll get taken out, and then you don't, it's not good. You have to be able to keep advancing and de-risking it and adding value all the way. And at the right time, if something happens, it happens. That's what I think.
Brandon, what are your thoughts about exit strategy?
Could not reiterate what Taj just said more. I think you need to have the right team to advance all the way to production, but over that process and the de-risking and project advancement exercise, there are certain inflection points, like the resource stage, like the engineering study, maybe some of the early permitting, where if you have the right scale, the right jurisdiction, and a lot of the key technical elements of being de-risked, you tend to be on the radar of a lot of larger companies. So I think you need to take the approach that you need to be able to go all the way to production. But with that, and if you do your job well, I think there are inflection points that you will be and have a lot of suitors at that point.
All right, Frank, I got a twin question for you here. I want to hear your quick take on exit strategy, but we also have someone who's asking why you believe there's a lot of gold in your project.
Exit strategy. Well, I've had a number of juniors that have been taken over already. I was in the uranium patch in the early 2000s, and we were taken over with Northern Continental Resources. Barkerville Gold Mines was taken over by Osisko Royalties. The shareholders did excellent on that. Stock was probably trading around $14 a share, currently trading north of 22. Plus, they're seeing a 26-cent a year dividend. So the current project that we have right now, we've been totally surrounded on three sides by Osisko development, so it's a natural for them. So Sean Rusin, in all his wisdom, has suggested that the project they have is like a beachhead, and they're looking sort of to develop the whole trend. They've been very successful in the Val-d'Or camp, and so I can see us, we'll just continue exploring and de-risking this project. It's a different model than what is in the Wells Barkerville camp. We're actually looking at gold in a different rock formation here, and it's more like it's a organic model, but it's it's different. The grade is different. It's more leans itself more towards open pit. This whole camp itself is, like I said, the last deposit. Cisco's developed or confirmed that there's 6 million plus ounces there that they're currently developing, and they'll be mining there for 30 years. 10 years is their first mine plan, doing 160,000 ounces a year. Looking north to where we are, we'll just keep building this model. We're just very early. We're only on the 9th drill hole of this program, so it's very early in the game, and we'll just continue on and hopefully either I've developed 2 in the neighborhood, so developing a 3rd is definitely possible, but I think that will probably be taken out.
Okay, very interesting. I want to give a reminder to our viewers right now. Investor TV is new. We have a website. It is investor-television.com. I want to encourage each and every one of you to go there and to register, because that way you'll get exclusive invites for our future panel discussions. And we have quite a few coming up on copper, on green tech, on artificial intelligence. So please do sign up for that. And while I'm sharing promos and advice, if you're looking for a deep dive into a technical analysis on gold, John, I understand you've got a great webinar coming out soon with Don Durrett. Where can viewers register for that?
Yeah, sure. So our website is fennecconsulting.com. If you look at the top right corner there, you'll see technical analysis. Just click on that and it'll get you a link to our event. It's going to be June 17 at 2 o'clock Pacific. Don and I teamed up on my YouTube channel 12 months ago, actually, because I think very highly of his work. He's an author in gold and silver. He actually works with Larry Leopard, who is a big portfolio manager in the U.S. in mining. And Don is just, his website, which is goldstockdata.com, to me is like the best source for gold and silver stocks, at least in the U.S. I can't say globally, but he tracks 800 to 900 names, and I don't know how he does it. But he is, just very bright when it comes to technical analysis. So we've never talked about that on our show before. And we wanted to do a webinar around that because clients, a lot of times don't understand technicals, and it really matters to us in terms of, identifying entries and exits.
Thank you. Definitely tune into that. There's a question from the audience, and I'm not sure if any of you gentlemen want to take a stab at this, but I'll ask it anyway, which is there a relationship between gold and cryptocurrencies? Are they complementary or competing when it comes to investment? John, I see you nodding.
I have a zero weight crypto. That's my bad. I don't buy stuff that's not regulated. And so I think there's going to be another shoe to drop there. That's where I'm going to enter crypto because clearly, we've seen a nice move there, which is, in my view, been predicated on ETF flows. And I've just been busy buying cheap gold and silver and copper stocks, right? I can't get distracted and buy crypto and Ethereum and all this stuff. So I feel like there's room for both. I know that's kind of maybe not the argument that most people would have, but I see crypto as more momentum than I see it as value. That's just my opinion.
All right, we're going to wrap up in just a moment, but I want to get one take from each of you now. As an investor, how do I decide how to divvy up my portfolio when it comes to physical gold versus ETFs versus mining companies versus another commodity? Taj, I'm going to start with you.
Yeah, I think I touched on it before, but for really, being truly diversified, it'd be great to have a bit of everything, and you kind of change your weighting depending on where you think we're at in the cycle. I would say, physical gold is the lowest risk on this side of things. ETFs, you got a basket of companies, so more leverage, a little more risk. And then when you look at the gold stocks, obviously more risk depending on where you pick from. Producers have the least risk, developers a little more, and explorers even more, but the rewards are more. And how I kind of simplify it is, listen, if gold goes from where we're at now to 3,000, right? Which is kind of like a 25-30% increase. Your producers, your gold stock producers are probably going to very high level, 5x, something like that. If things are going right, they're going to have to catch up and then go up. So that bodes well for the sector overall. But if you look at a developer and an explorer, we've seen it many times before, 10, 20, 30x's. It's just going to happen. It will happen. And so that's where you really get that push with the gold stocks, is the torque, the leverage that John had talked about, that all the panelists here have talked about. So simple answer is kind of, I think you should have a balance, and weighted is where you think you're in the cycle. Right now, if we're actually in the early innings of a bull cycle, I would say you should be much more heavily weighted on the stock side of things. Yeah, that's my take.
Frank, what would you say?
I couldn't have said it better. In the beginning of a bull, the juniors, the junior companies will actually, there's 10 baggers out there. If you looked at Barrick or something, you'd like to see that at $45. So that's a double. But in the beginning of a cycle, I think that the junior market is really the place to be. And management is usually really quite aggressive in trying to get their share price higher. The holding physical gold is a great thing to have. I do have some, so it's you always want to have that in your portfolio, and that just sort of goes with inflation. The ETFs, it's a mixed bag, so it's you're getting the good and the bad, and not they don't all do that well. So that's why you buy an ETF, and it hedges your bet. But I really think that the junior place is the place to be, because the seniors will improve, and the juniors will then follow them, and they'll follow them at a faster rate. So if you get into the junior market early, you'll do much better. And so I'm really heavily betted on the junior market in the beginning of a bull market.
Okay, bet on the juniors in the beginning of a bull market. Brandon, final thought.
Timing is everything in our world. And I think, as Frank just touched on, we're so early on a lot of these juniors. You could buy them and put them away, and you'll see 10, 20, 30 X's quite quickly. So I think it's a great place to be now. I don't think the run has started. And I think a lot of these names will very stealthily have 10, 20% days on the trot, and people will say, wow, I missed that one, or I didn't get in early enough. And I think the timing is right now. And as Frank just touched on, a Barrick can 2 to 3X, but some of these smaller cap companies have the ability to really generate that significant torque and leverage, which for a higher risk profile of investor can be quite meaningful.
John, final thought for investors, for people watching today?
Sure. So we have an 8.5-year public track record in mining. If you go to fennecconsulting.com, you can click performance and view that. And if you like what you see, you can go to the subscriptions tab, and there's different ways that we can work together. And to answer the question, physical gold, we're at 1% right now. GLD or IAU, the actual gold ETFs, we're at a 0% weight. GDX and GDXJ, we're over 10%. And we have about 30% in just gold stocks like the three here and others, because we're going to see a tremendous run in some of these names in our view.
All right, fantastic discussion, gentlemen. I got to say, among the points that I picked up is that miners' margins are set to increase more than their costs, and that will be not only good for their bottom lines, it could mean that mining stocks are really due for a significant rally. I want to add that the on-demand version of this discussion will be available online next week. Just go to the investorTV YouTube channel. And remember to sign up at investor-television.com to receive updates on our next panels. You've been watching Navigating Capital Markets on Investor TV. I'm Michael Switow.